Anyone who invests for the long run eventually realizes something uncomfortable. Long-term investing is boring. There's no daily action, no constant, thrilling decisions to make. For weeks, sometimes months, it can feel like you're just sitting there watching paint dry as the market goes wild somewhere else. And this feeling, this deep sense of boredom, is exactly why so many investors fail. They give up, convinced that nothing is happening. But that perceived inactivity, that quiet stillness in your portfolio, it isn't the problem. It's the entire point. That boredom is what makes long-term investing actually work. The human brain, unfortunately, is not built for this. We are wired to react. Our instincts crave excitement, movement, and breaking news headlines. The modern world has weaponized this against our wealth, with trading apps designed like slot machines, flashing with confetti and alerts that give us a little dopamine hit every time we press a button. Stability, in contrast, feels profoundly uncomfortable, even when it's precisely what our money needs to grow. This leads to the single biggest mistake an investor can make: confusing activity with progress. The data is clear on this. Studies consistently show that the average investor dramatically underperforms the market, and the primary reason is that they do too much. They trade in and out, chasing trends and reacting to fear, believing that more clicks will lead to better results. In the market, doing more often just means doing worse. Your only true edge over the algorithms and the quarterly driven fund managers is your time horizon. They cannot afford to be boring. You can. Nowhere is this truer than with dividend strategies. They feel especially unexciting. Dividends are predictable. They don't make headlines. They don't get talked about on social media. They simply show up in your account quarter after quarter. And over time, that boring consistency becomes an almost unbeatable advantage. While others are chasing speculative excitement, your stable cash flow is quietly compounding. But a word of caution: boring cannot mean blind. You can't just buy a stagnant stock and ignore it. The key is distinguishing a boring winner from a value trap. A boring winner is a company whose business is quietly improving. Sales are up, debt is down, even if its stock price is flat. A value trap is a company whose stock is cheap because its business is dying. The dividend yield might look high, but it's a ticking bomb, unsupported by actual cash flow. So the solution isn't to make investing exciting, it's to build a system that protects you from your own need for excitement. It starts with simple rules. Look at your portfolio less often. Seriously, delete the apps from your phone. If you feel the urge to trade, enforce a mandatory 24-hour waiting period. Shift your focus from the daily price to the annual income your portfolio generates. Is that number going up? If so, you're winning. Automate the process. Use a dividend reinvestment plan or DRIP to automatically turn your payouts into more shares, creating a snowball effect without you ever having to lift a finger. Long-term investing is boring because it's slow, methodical, and emotionally quiet. That's not a flaw in the strategy. That is the strategy. Patience is not a passive virtue. It is an active professional skill. It is your ultimate competitive advantage.